Mortgage finance is a specialized field within the broader financial industry that deals with the lending and borrowing of funds for the purpose of purchasing or refinancing real estate. It plays a crucial role in facilitating home ownership by providing individuals and businesses with the necessary capital to buy or invest in properties. Here's a detailed explanation of mortgage finance. 1. Mortgage basics. Mortgage. A mortgage is a legal agreement between a borrower, home buyer, and a lender, usually a bank or mortgage company. It allows the borrower to obtain a loan to purchase a property while using the property itself as collateral. This means that if the borrower fails to repay the loan, the lender can take possession of the property through a process called foreclosure. 2. Key participants in mortgage finance. Borrower, the individual or entity seeking to obtain a mortgage loan to buy a property. Lender, the financial institution or entity providing the mortgage loan. Real estate agent, facilitates the property purchase process, including finding suitable properties and negotiating terms. Appraiser, determines the value of the property being financed. Title company, ensures the property's title is clear of any encumbrances and manages the closing process. Mortgage broker, an intermediary who connects borrowers with lenders and helps with the loan application process. 3. Types of mortgages. Fixed-rate mortgage. The interest rate remains constant throughout the life of the loan, making monthly payments predictable. Adjustable rate mortgage, ARM. The interest rate can change periodically, typically based on an index. This can result in fluctuating monthly payments. Government-backed mortgages, loans insured or guaranteed by government agencies like the Federal Housing Administration, FHA, or the Department of Veterans Affairs, VA. Jumbo mortgage, a loan that exceeds the conforming loan limits set by government-sponsored entities, GSEs, like Fannie Mae and Freddie Mac. 4. Mortgage application and approval process. Borrowers apply for a mortgage by providing financial information, such as income, credit history, and assets. Lenders assess the borrower's creditworthiness and evaluate the property's value. A down payment is typically required, with the percentage varying based on the loan type and lender. Once approved, the lender disperses the funds to the seller or the borrower, depending on the purchase type. The borrower makes monthly payments that cover both principal and interest over the loan's term. 5. Interest and repayment. Mortgage payments consist of both principal and interest. Early in the loan term, a larger portion of the payment goes toward interest, while later payments increasingly reduce the principal. The term of a mortgage can vary but is commonly 15, 20, or 30 years. The interest rate on a mortgage is influenced by factors such as creditworthiness, prevailing market rates, and the type of mortgage. 6. Securitization and secondary mortgage market. Lenders often sell mortgages in the secondary mortgage market to free up capital for new loans. Mortgage-backed securities, MBS, are financial instruments created by pooling thousands of mortgages and selling shares to investors. Government-sponsored entities, GSEs, like Fannie Mae and Freddie Mac play a significant role in the secondary mortgage market. 7. Default and foreclosure. If a borrower fails to make mortgage payments, the lender can initiate foreclosure proceedings, leading to the sale of the property to recover the outstanding debt. Foreclosure laws and processes vary by jurisdiction. 8. Regulation and consumer protection. Mortgage finance is heavily regulated to protect borrowers and ensure fair lending practices. Regulations include the Truth in Lending Act, TILA, Real Estate Settlement Procedures Act, RESPA, and the Dodd-Frank Wall Street Reform and Consumer Protection Act. 9. Tax applications. Mortgage interest payments are often tax-deductible, providing a financial incentive for homeownership. Tax laws regarding mortgages may vary by jurisdiction and change over time. In summary, mortgage finance is a complex system that involves borrowing and lending funds to enable property ownership. It encompasses various types of loans, participants, processes, and regulations. Understanding the intricacies of mortgage finance is essential for both borrowers and lenders to make informed decisions and ensure responsible homeownership. It's important to understand all aspects of mortgage finance to add value for your clients and grow a thriving real estate business. To become successful in real estate, the first thing you need to know is your value. Clients today, both buyers and sellers, have access to more information than ever before. Consequently, they need to see clear value in using a real estate professional. It's your responsibility to show them what your value is. While many agents may know the most recent trends and listings in today's market, And many understand the home buying process generally. Far fewer have a firm grasp of the mortgage financing process. Think about that for a second. Many real estate agents know the least about the home buying process that is essential to secure any sale. Every sale and every closing hinges on the buyer's ability to access the necessary funds, and the vast majority of homes are financed through mortgage loans. On top of that, research shows that when it comes to first steps to buying a new home, home buyers are more than twice as likely to contact a real estate agent than a mortgage lender, and 94% of clients consider knowledge of the purchase process one of the most important skills for an agent to possess. This percentage is even higher for young people, many of whom are first-time buyers. Potential clients are looking for real estate agents to help navigate them through the financing process. It's up to the agent to deliver. There's a reason real estate professionals aren't as knowledgeable about mortgage financing. It's complicated business. The field is in constant flux. Lending standards and practices change. Finance laws change. Lender products change. Sometimes these changes occur in sync with the ever-changing real estate market, sometimes not. It's important that you understand not only the current laws and trends, but also how mortgages and financing options have evolved over time. Knowing where we came from will help you better understand where we are today, which is what your clients want. A knowledgeable real estate expert who can guide them through a thicket of laws, paperwork, and financing options. Home buying is a stressful endeavor, especially for first-timers. Your knowledge of mortgages and finance can help de-stress and demystify the process. To begin demystifying the process, we should first learn some basic terminology associated with mortgage finance that is integral to the process. We can then learn more by taking a brief look at the history of the mortgage industry and how we got to where we are today.